Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today I'm joined with my good friend, Doug Hagren. Hey, Doug.
Hey, good, Kirk. Good morning. And hey, I'm proud of you. I actually noticed, that, maybe you've been doing this, but you seem to be getting into your vocabulary. X versus Twitter. Impressive. Most people are still struggling with that conversion. I still don't even know what you call it. Is you're not tweeting anymore? Are you Xing? I don't know, but I'm proud of you. You've caught up on the lingo. Congratulations.
Thanks, Doug. That's just so nice of you to say.
Well,
The congratulations I can get sometimes. Yeah, I still struggle with that too. I want to call it Twitter because I don't know. They don't seem to know what they're doing over there. I mean, if you're gonna, can't call it a tweet and change it from Twitter to X, but formerly known as Twitter, I don't know. We'll see what happens. But anyway, let's dive right in. So I want to start this week with, we're going to talk about big predictions for 2024, and Doug and I are going to kind of give our predictions. But want to give before we do that, want to give two frameworks. So first, I want to point out that as of yesterday, Bitcoin went live, and we just got a ton of new ETFs out, and we'll talk about that in the show. There's a bunch of things I want to point out which are really fascinating to me. But otherwise, here's what I want to point out. So this is the time of year where everyone gives their big predictions for 2024. Here are all the things that are going to happen. And, hold on, let me get out my crystal ball here. I'm going to rub my crystal ball, get my tarot cards, got my tinfoil hat. We got it all here, Doug. It's prediction time. Let's start with this year's predictions. Here's my prediction for 2024. The stock market is going to go up, it's going to go down, and it's going to go sideways, and not necessarily in that order. So that's my prediction for 2024. I guarantee that's going to be correct. So I bring this up because every single year, certain people come out with their predictions. And some people have been doing this for 40 years. And, I remember when I started, there were a handful of people that come out with predictions. I think Byron Wien, who I think passed in October, used to do annual predictions. You had Art Cashin, who used to do predictions. A whole bunch of old timers who did predictions. And the funny thing is everyone loved the predictions. Yet they were almost never correct. And no one ever went back to see if they were correct. So as soon as you put them out, it gets lots of fanfare, and then no one pays attention because things change. Now, I bring this up because we're all baited towards predictions. Oh, what's going to happen this year? Where should I put my money? Someone's going to predict this. It's a guess. It's a complete guess. And there's no one doing any sort of follow-up on these. So you don't know if the predictions are generally right or not right. And then every once in a while, and some of these people, I think Byron Wien used to do this, he would send out, if it wasn't him, it was someone I'll get the name, but they would put out these really crazy predictions. And they would say it. They were like, here are some crazy predictions that no one's talking about, but I think there's a reasonable probability they're going to happen. They never came true, right? Every once in a while, one did. Oh, I predicted the pandemic. Yes, you predicted the pandemic for, you were correct 1 out of the last 20 years that you predicted. Every year you predicted a pandemic. And when it happened, hey, I was correct. That's a lot of this. That's a lot of the media behind predictions. Is people make predictions all the time, and then they pull out the ones that are correct and be like, look, I was correct. Well, yes, if I were to predict the stock market's going to go up, it's going to go down, and it's going to go sideways, I'm going to be correct this year. All of those things are going to happen. And yet, all you do is pick one and be like, yes, look, it went up, but I was correct. I mean, the ridiculousness of this is beyond comparison. And people don't stop to think about that this is happening, but everyone does it. And you know what? We as human beings are baited to look for this. We're baited to look for the future. We want to predict what's going to happen next so we can make sure there's no saber-toothed tiger behind the bush. Like we're wired like that since, thousands of years ago. We've been wired that way. And yet we still do it, and we still don't realize that we're doing it. So this time of year, when you're seeing predictions, take everything with a grain of salt. Okay, I can make some predictions, but the fact that I'm going to give you a prediction at the same time I'm telling you that this is going to be a guess, you should keep that in mind, not be like, all right, I just heard what you said, and now take your prediction, be like, here's what I'm going to do. Don't do that, right? The predictions are based on what we're seeing today, right? What we think is going to happen based on what we're seeing today. And frankly, my guess is no better than anybody else's. That's why we don't predict the future, we manage risk, right? I can't predict the future. No one else can predict the future. If somebody else says, hey, this is what's going to happen this year, run. Because they don't know, right? And if they don't know that they don't know, then they're not as smart as they're telling you they are, right? You have to acknowledge up front that you don't know the future. So while I might say, here's what I think, it's not, here's what's going to happen. Those are two very different things. Now, that being said, that's why we manage risk. You can manage risk. I'm going to paraphrase. I don't know if it was Buffett or Benjamin Graham who said this. I think it was Benjamin Graham who said basically, you can't manage performance, but you can manage risk. He said
it is Graham.
Yeah, he said it in paraphrasing him. But you can't manage performance, right? I can't make the stock market go up. I can't make it go down. I can't make it do anything, right? All I'm doing is guessing, right? I invest and I hope it goes up. So you can't predict performance, but everyone tries to. They try to manage performance. Oh, I'm going to do this. I'm going to do this. You can't manage that, right? All you can do is make your best guess of what's going to happen based on the investments you're making. Oh, I'm investing in, let's say Apple drops 98%. You're like, well, I think Apple's still going to be around, so I'm going to put some money in it. Okay, that's a prediction. But you could, based on fundamentals, you might say, oh, that's a good prediction, right? Like it's sound. But you don't know. However, you can manage risk. There are many ways you can manage risk. You can manage it on an individual stock level. You can manage it on a portfolio level. You can manage it on an overlay, which is some of the stuff we do. You can manage it on due diligence, right? You could do better due diligence. There's many different layers of risk management that you can employ. And people have different techniques. Some people use diversification. I don't think that's risk management. I think that's volatility management, not risk management. But there are things you do to manage risk. There's position sizing. We didn't talk about position sizing. Position sizing is a great way to manage risk, right? You could invest 1% of your funds into something, or you can invest 100%. Your outcomes can be very different based on what you invest in. So all these different factors kind of combine into your portfolio, and you can manage the risk on that, right? Just allocation alone, you can manage risk. And every single one of these does similar things. So you can definitively do that. Like I can definitively tell you that if I do a certain thing, like I can construct something with the tools that are available in public markets. I can construct something that says, and I can't use the word guarantee, so I'm going to caveat this. I'm using guarantee I probably can, but I can't as an advisor can't use that. So just keep in mind that I'm using this in a different way. I can tell you that if a certain things happen, I can guarantee that the outcome is going to look like this, right? If you carve it out in a certain way. And there's ways to do that, right? You could say, hey, if I put in $1,000 into a U.S. Treasury, I can guarantee you that you're going to have $1,000 plus your interest at the end. Technically, I'm allowed to say that. As long as you don't sell it or anything, as long as you hold it to the end. So there are certain things you could do and say, okay, I'm comfortable with the outcome, right? Here's the input, here's the output, I'm comfortable with that. Yeah, but I want to make better return. Okay, well, you got to take a little more risk. So there's different things you can do to carve out that risk and say, well, I don't want to lose more than X. Okay, there's things you can do, right? You can do stop losses, you can do options, you can do allocations, all sorts of things you can do to make sure that you're managing that. Point being is you can manage risk. You can define it. You can say, I'm not losing more than X. And you could say, great, that works. Most advisors can't do that because they don't know how to do it. They're not skilled at it. But it can be done. So understand that dynamic is in play. So when you're talking about predictions, look, I've heard, and I'll start this, and then we'll get into Bitcoin in a second, and we'll get into the predictions. I want to hear Doug's predictions too. But if I'm thinking about my predictions, I'm going to give a few frameworks that we should think about. First framework is this. I think that at this point, people have been talking about the recession for the last 2 years. And 2022, we kind of had a recession, although they haven't called it a recession, which is kind of weird. But anyway, we haven't had a recession in a while since COVID, really, if you call that a recession. That was weird too. I think we're overdue for recession, but the economic factors aren't lining up such that we see it yet. Now it looks like it's going in that direction really slowly, which is a surprise because that's not how our stock market moves. It's usually very quick, like we have a crash. We're not really seeing crash type numbers. We're seeing a slow slowdown, which is in line with the soft landing, which makes me a little suspicious about the numbers. But we are seeing a very slow decline or slow ease into recessionary territory. We're not there yet. I don't think we'll see it till Q2 of this year at the earliest. Now, if we have a crash, something happens, something blows up, all bets are off. But so my prediction is if we start to see a little bit of recession, it happens in Q2. I think that everyone's calling for one, and people have been prepared for one for a while. And I think people are going to be surprised. They're just going to continue to be surprised that there's no recession. I also think another surprise prediction for this year is people have been predicting that rates are going to drop. Even Powell said we're going to drop rates. I think that I think people are going to be surprised there. I think rates are going to drop fewer times than people think, fewer times than Powell has said. I think people were predicting like 7 or 8 times this year. I think he said 4. I think we'll probably maybe have 2, if any. We'll see what happens in the economy because inflation picked up a little bit yesterday with the CPI. But I think that they're trying to be cautious, and I think that's the right move. Personally, my prediction is I think rates are going to drop less than people are predicting. I think people have been way ahead of the curve on this and wrong for the last 2 years. So I wouldn't be surprised if they're continuing to be wrong in the bond market. So that's a prediction I would have this year. I was going to predict that Bitcoin was going to come public with an ETF, but that happened yesterday. So I'm still making that prediction. My prediction is 2024, we're going to have Bitcoin ETFs. See, I'm right. Doug, look at this. I was correct. And I guess the last prediction is I think people are going to continue to be surprised at global chaos. People have been predicting the end of the world because of what's going on with Hamas and Israel, with Ukraine and Russia. I wouldn't be surprised if there's further conflict, but I think people are going to be underwhelmed with the conflict that's happening. I think people tend to overblow their worries initially, like when that happened, when Israel got attacked by Hamas, and then they retaliated. People like, oh, we're going to have World War III. Here it comes. And that hasn't happened. Not saying it won't, who knows? I don't know the future either. But things tend to be less crazy than most people predict. And they predict them because it sells newspapers and it gets eyeballs. So they're predicting the end of the world because they want you to watch and listen. And that's human nature. We get appeased by that. We want to see that. We want to see the car wreck when we're driving by. It's crazy, but that is those are some of my big predictions. I'll probably have some more. I didn't write them down because the Bitcoin thing came out and I was like, all right, I want to pay more attention to that.
I live in the great state of Massachusetts. I may be the only one who calls it that, but I digress. The great state of Massachusetts has a commercial funded by the state that says, you can't win the lottery if you don't play. For the moment, let's ignore the fact that there's a state-sponsored commercial suggesting that you go out and spend your hard-earned money gambling on lottery tickets with odds of over 100 million to 1 of winning. But it's true, you can't win if you don't play. I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. I'm only asking 5 to 10 minutes of your time. But I will pay you at least 100 million Zim dollars for your time. We do have some foreign listeners, so if you don't like Zim dollars, we may have some other currencies as well. If you want to earn over 100 million Zim dollars, go to www.moneytreepodcast.com/free money to get your free money today.
So, Doug, what are some of your predictions at the moment?
Well, I mean, my biggest, here's the thing about predictions, and I just posted a couple things to look at, but there is a Yiddish proverb called "Man plans, God laughs." Okay, so if you want to change it up, you could say "Man predicts, God laughs." I mean, my prediction for this year is that there's going to be volatility. That's all I can tell you. That the markets are going to move, like you said. They're going to go up, they're going to go down, they're going to go sideways. We started off the beginning of the year We had some pullback all of a sudden, where we could, and now that's kind of tempered out a little bit. Lots of people were predicting going into this year that with the release of Bitcoin ETFs, that this is going to shoot Bitcoin to the moon. I mean, and that may still be the case, but I was just looking at how Bitcoin was doing this morning since its launch. It's actually down for the at least one of the ETFs for the last day has actually dropped somewhere in the range of close to looking at
Around
maybe 12% value. So I mean it's one of those things where, I mean, one thing I will tell you that, in my prediction, and it's not really a prediction as it is just a recommendation of advice, is don't fight the Fed. I mean, at the end of the day, people have tried to fight, talked about fight, tried to come up with predictions, and they've tried to come up with, opinions about where things are going to go. And at the end of the day, the Fed has a lot of control over this, and they continue to be the ones that have had tremendous influence. So wherever I wouldn't predict what the Fed's going to do, but I would certainly be cognizant to reacting to it. There's a gentleman, forgetting his first name, last name Sherman. He put together a nice little acronym: predictions, opinions, outlooks, and forecasts. What do they spell? Poof. Okay. And there's been plenty of predictions that have been made over the year. If you look at prior to 2000 and, the crash of 2008, you look at the beginning of that year, there were people like Rick Wagner of General Motors, and you had Kramer, and you had Jamie Dimon, and all of these people committed to, there's no comparison. Lehman Brothers is much, much better than Bear Stearns. These were the predictions that were going on and being made in 2008, in January and April and September of 2008. Bullish, bullish, bullish. As a matter of fact, there's a list in Business Week, 2008 forecast for the S&P 500. They listed somewhere in the range of maybe about 15 different people from, different firms and banks and brokerages. And there were only 2 of those that had predicted any type of negative decline in 2008. A gentleman from GMO and another gentleman from Research Affiliates both had predicted a slight decline, although nothing near the actual result of negative 38.5%. The average forecast was almost a positive 10%. And and there's plenty of, Dow to 100,000 was a popular book that was, that I think it was a New York Times bestseller. That we still are nowhere near close. Dow to 36,000 was a book that was written. And again, both these books came, I think, basically in the 90s, early 2000s. We finally, got to the, range within 36,000, but Dow to 100, not happening anytime soon. Okay. So, and there was a lot of confidence believing, and this is not just predicting bearishness. This is also talking about, these predictions will not only get you in the markets at the wrong time, predictions will also keep you out of good markets as well. So negative predictions can cost you from from your ability to be exposed to the growth that you need. Wall Street Journal did an article, looking at this, I think this was 2010, about the dismal performance of experts and they did a case study, an experimental of 284 people who made their living commenting or offering advice on political and economic trends. And what happened from this, began asking them to just make predictions on anything over the next 2 decades. This was 20 years long that he did this. He peppered them with questions. Would George Bush be reelected? Would apartheid in South Africa end peacefully? Would Quebec secede from Canada? These were some of the options. And by the end of the study, they quantified 82,361 predictions. And guess what? How did the experts do? When it came to predicting the likelihood of an outcome, the vast majority performed worse than random chance. Not equal to random chance, worse to random chance. In other words, they would have done better picking the answers blindly out of a hat. And it didn't matter. It does not matter. The political divide of the spectrum, liberals, moderates, conservatives, equally ineffective. They found that fancy degrees were mostly useless. And as a matter of fact, one of the takeaways from this, they actually found out that in many cases, the more fancy of your degree, and Kirk, you and I have talked about this, the more likely you were going to be wrong, and the more likely you were going to stay convicted to that wrong answer, even after the evidence was presented to you as fact, because there becomes a strong aversion to being able to admit that maybe you don't have necessarily the right answer. Let's go back to Alan Greenspan's irrational exuberance. December 5th, 1996 is when he made that speech. The NASDAQ 100 was at 835.8. It then ran 3 years later to 4,704. So here he is. He's saying, guys, this market is completely overblown. There's an old saying that history tends to repeat itself. How many people have been saying that the market is overheated, that the market is overvalued in this current market for years? Now, I'm not saying it isn't. Okay, there's a lot of data that says the markets are completely overheated. There's also some data out there that says there's plenty of opportunity to grow. The conditions are different. But the problem is that if you go with that prediction, and let's say you react to that prediction, and let's say the prediction is the irrational exuberance speech, and now you're out of the markets for 3 years, and it runs, I'm trying to do the math on this, but 500, I'm guessing 500% return. Or on the opposite, it's 2008. Everybody's telling you, and we've heard a little of this in December and November. Everything's going to be great. Markets went on a run. 2024 is going to be the year that the Fed decides we're going to lower rates and inject some adrenaline into this market. Well, if it's 2008, everybody's predicting, an average return of 10%, and the market ends up down 36. At the end of the day, don't know. You've got to remain flexible, and you've got to ebb and flow with the data you have. But don't listen to the predictions and say, listen, if there was the ability to make those type of predictions, you don't want to react to the prediction. You want to buy that crystal ball. That's what it comes down to.
Yep.
That's what I would be buying, not the advice. Where are you getting it from? That's where I'm putting my money.
Yeah. No. And there's one more chart I want to share here, because I actually do this a lot, and I think it was a great chart you shared, which is diversification. We talked about risk management earlier. Most people think diversification works as risk management, but it's not. So diversification works in an up market, doesn't work in a down market. And so this chart basically shows 9 different markets, emerging markets, S&P, Russell 2000, Europe, all these different things. And you can see from 2003 to 2008, or I guess the end of 2007, huge difference in spread. So all you're really doing is you don't know which one's performing the best. So you just kind of find the middle, and you're diversifying. So you're trying to find the median there for returns, and just kind of average them out. So that's why diversification works. You're not picking one over the other. Now the problem is this: diversification doesn't work in a bear market. Look at 2008, 2009. Everything correlated. Now, I remember this because I was looking at returns. As we were kind of managing the 2008 crisis when it happened, I was looking at returns, and virtually everything was down 58.5% within a few percentage points. That shouldn't happen, right? What should happen is, well, some things are down 10, some things are down like 40, some are down 50, whatever. Like, they're all over the place. Look at here, like almost everything was around similar percentage points at the end of 2008, right around 60%, some of thereabouts. If you look at, I don't know if you can see my pointer here, but you see my pointer is like everything was down a very similar amount. It shouldn't be that way. That's not how it's supposed to work. Diversification is supposed to, save your butt, right? And it didn't here. Right? Because everything correlated. And when there's massive sell-offs, you can see everything correlates, even here. The returns correlate. And then at some point they start to spread out, because I don't know if you remember, but gold was actually one of like two assets that were positive in 2008. It was like gold and cash, or basically short-term treasuries, were positive. Otherwise, everything else is negative. And so diversification doesn't save you when you're trying to manage risk. That is very different than managing volatility. Now, I do want to, we talked about our predictions this year, which are important. We also want to talk about Bitcoin. As of yesterday, the first, I guess, 11 is the number that I found. 11 ETFs went public, Bitcoin ETFs, and including the conversion, the GBTC conversion from closed-end fund to an ETF. So all that happened yesterday. That was the first trading day. And like we've predicted in the past, what happened? Well, here's what happened. Pretty much that marked the peak of Bitcoin's price, and it's gone down. As of right now, it's down around 6% and change. But I don't want to pick on a single asset class, but I do want to use this as an opportunity to talk about some really important items. And here's the important item that I want to mention. When you're looking at this as an example, right? You're looking at Bitcoin. If you've owned it, great, lucky you. You were fortunate to have a huge run up that we had in Bitcoin from pretty much January 1st of last year up till the end, and then it peaked out pretty much day of or day before. I think it was the day of it came out, and then it's just gone down since. Now I want to point out two things. First off, if you look at the history of Bitcoin, the peaks have been marked by Coinbase going public. I think it was BitO was an ETF which was backed by futures, which is not the same as backed by actual coins, because there's some drag on the returns because the futures have a forward roll in them, and that typically loses money over time. So that's not a perfect ETF. Some of the ETFs are built with futures, like a lot of the commodities are based on futures. So you'll tend to have a lesser return than you get in the commodity because there's that roll. If you don't understand what I'm saying with the roll, don't worry about it. Just understand that it's not the best vehicle to use if the futures are backing. It's much better if it's the actual asset itself. Now, what's happened is 11 ETFs came out, and I just saw the news as of yesterday. I think 87% of the Bitcoin volume was centered around three ETFs. It was GBTC, which was the grayscale closed-end fund. That was the original one. It was the only option, really, to invest in the Bitcoin itself. And then I think Fidelity's, and I think the other one was BlackRock, maybe. I can't remember. There's a third one. But anyway, most of them were that. Now, if you read between the lines and you kind of look, they didn't outline this, but a lot of the funds were shifting from the grayscale into other ETFs because it was the only option. And what I find fascinating, and this is the part that I really want to point out for this, I'm not going to talk about the performance of Bitcoin or anything like that, even though it doesn't look good at the moment. What I want to talk about is now you've got 11 different cryptocurrency ETFs that are only in Bitcoin, okay? And some of them are named shares, like Fidelity's in the game, Wisdom Tree, VanEck, iShares, ARC 21, and Grayscale, and ProShares I think has one too. So there's a few of them out there. Now, how do you choose? All right, so I want to talk through the thinking here because I'm going through this too. So I want to talk you through the thinking that I have as we're going through. Now, we want to look at a few different things. The first thing you want to look at is expense ratio. Well, that's an obvious one, right? Well, what's the expense ratio? That's a good indicator of which one I should invest in. Okay, well, let's do that. And let me just bring this up. My windows don't seem to be open here. Okay, well, anyway, as I'm opening this up. All right, so Bitcoin ETFs. So there's a bunch of Bitcoin ETFs, and the few of them, let's see, here they are. Okay, so there's Bitwise, Grayscale, Hashdex, BlackRock, Valkyrie, BizX, Invesco, VanEck, Wisdom Tree, Fidelity, and Franklin Templeton. Okay, those are the ones that are listed in this article here. Now, if you look, there's actually a bunch of each one has their own expense ratio. I'm not sure why I can't find this. I don't know if you can find it, Doug, but it's not popping up for me. 1 second. Here we go. Okay, I got it. All right. So if I look at the Bitcoin ETFs, so let me go through a few of them. So ProShares BitO has a 0.95 expense ratio. As of yesterday, Grayscale had 1.5. It used to be 2, and they dropped it to 1.5. The looks like ProShares has a short Bitcoin strategy. I'll have to look into that. 95 basis points, 76 basis points for Van Eck. Valkyrie is 1.2. Global X has 0.65, and so on and so forth. And I think the lowest ones are ARC has 0.21, and I believe Fidelity has 0.25. Now, that's so if you're looking at expense ratio, naturally, let's pick the cheapest, right? That's the natural opinion. You should pick the cheapest because it's cheapest, right? You're owning the same thing. It shouldn't matter. Okay, so let's look at another thing. So I've noticed today, as I've been looking at this, the performance of Bitcoin of the top ones, I don't know, there's like 7 of them that I picked. There's more, but I just picked 7. And if I look at all 7, the performance today has actually been a pretty big spread. At the moment, negative 6.83 is the lowest performance, and the highest is negative 6.36. That's 0.5% difference for the same thing. So you have to ask yourself, well, obviously I want to pick the one that goes down the least. Yeah, but it might go up the least too. What's going on? Why is there such a big spread in this? Now, I don't know that I could point to something definitively. I've never heard anybody outline it. I just noticed it. And so if you go back to 2008, look at, I don't remember if it was an inverse financials. I don't remember if it was the inverse financials or the double inverse financials, but I remember, the financial system was imploding. So personally, I was like, let me take a few bucks and put it in the inverse financials. How can I go wrong, right? Things are imploding. It should probably do well. Well, the financials went down like 60 some odd percent, maybe 70 or something like that. But the inverse one actually lost money. How is that possible? It's supposed to be tracking the opposite. So if I'm invested in the financials and they go up 10%, the inverse should go down 10%, right? It should be the opposite. But if the financials go down 50%, this should go up 50%. But it didn't. It was actually like down 10. I'm like, how is that possible? Well, I don't know. First of all, I think these things happen. It was a relatively new ETF. It was like a month old. And so it was relatively new. And what tends to happen with new ETFs, new closed-end funds, there's tracking errors, there are mistakes. Nobody's come out and said this is what it is. I'm just telling you from my experience, this is anecdotal experience, is that when new ETFs come out, there's a lot of tracking error, stuff gets messed up, it doesn't act the way you think it should. But it is important to keep in mind, like, what am I investing in? I shouldn't just blindly throw money at this thing. A 1.5% expense ratio compared to 0.21 is a big difference. Now, if I'm in Grayscale, I might say, well, now I want to move out because of lower expense ratio. Maybe you should. I don't know. But I'm certainly not going to make the change today with 2 days of history under its belt. Maybe some of these are going to really screw up. I don't know. And maybe a month later and be like, yeah, we had a problem. We fixed it. I would much rather pay a higher fee for a month or two, let all that stuff sort itself out, and then come back and be like, all right, this one is getting more weight. The public is putting more money here. The expense ratio is low. I know it's tracking well. Let's put it there. Personally, I would wait till all this is over anyway, just because there's just a lot of stuff floating around. And I know it doesn't make sense. And I'm not saying this from a logic sense. And this is why I'm pointing it out, is that I couldn't sit here and say, ABC happened, so DEF is going to happen. That's the problem, is that's what it should be, but that's not what's happening. And so when you see a spread that large, it's better just to wait. Just wait, because some of these may be pricing at the end of the day. They might be pricing intraday. I don't know. But I know that there's a lot of shifting because you had 100% of the volume in GBTC, and now it's spread between 11. Naturally, you're going to have some people moving from GBTC into some others. So there's probably going to be a lot of selling there and a lot of buying there. They're not actually the lowest. They're right in the middle of the pack of the returns for the day. So something to think about is what's the performance compared to each other, compared to what it should be. You can mark that against the live Bitcoin price and how that's performing. Look at the expense ratio. That's another. You want to know how it's constructed. I know no one's doing this because they just came out 2 days ago. There are some people, but most people are not. They're just putting money in and not looking. Pay attention to how it's constructed. Is it priced on end of day? Is it priced live? Is it what's it invested in? How is the crypto safe? Are they leaving it on exchange or are they putting it in a cold storage wallet? These are important questions, right? If it's on exchange, which exchange? You don't want it to be on FTX, right? That would be a problem. So, you want to think through like where are all these people doing their business and is it safe? Because Bitcoin's generally pretty safe if you adhere to the precautions that are available to the public. But I don't know how these companies are doing it because I haven't looked through all 11 yet. I know how Grayscale did it. I don't know how that changed, but keep in mind, this is a brand new asset class. I think as of yesterday, I saw lots of evidence that Vanguard is not allowing their customers to invest into Bitcoin. I believe Merrill Lynch has also said the same thing. I don't think they've come out publicly and stated it. I've just heard anecdotal evidence from clients of theirs who've said they're not allowing me to do this. So I could be wrong, but that is anecdotally what I've heard. And I'm not surprised because many of these big brokerage firms do that. They say they don't allow their advisors to invest in inverse ETFs or leverage ETFs or some new and weird asset classes. They just say, no, you can't do it. It's more of a CYA on their part. It's a risk management thing on their part. It's totally their choice. They have a right to do it. Not begrudging them, but just be aware that there might be rules that the custodian puts on you that aren't rules that everybody has, just that custodian. So something to keep in mind. Do your research this weekend if you're going to invest. I'm happy that this went through, but I think long term this will be good for the cryptocurrency, blockchain industry and market. Short term, I think there'll be a lot of volatility, as Doug said, but definitely something to keep in mind. So Doug, where do you want to go from here? We've got lots to talk about today.
I'm just going to add one last thing to that. And I saw some stuff last quarter, just stuff that's going around. It reminded me a little bit of actually, I think it was Kennedy's, the Kennedy family father. What's his name? The patriarch. Joe. And when he talked about worrying about the depression, when he knew that taxi drivers were giving advice, the one thing I will say about it is, again, predictions. Lots of predictions, a lot of reasons to think now as it's continuing to gain more traction and a lot of the currency issues that Bitcoin or Ethereum or other forms of, cryptocurrency or more matter of fact, blockchain in general is here to stay. That being said, don't bet everything on it. I was seeing texts, I'm not text, X's, tweets, I guess last quarter, lots of people saying, things like, oh yeah, my unemployed brother just took out, a loan for, or just liquidated his 401k or just did this, and put it all in Bitcoin. Okay. Don't do that. Don't be that person. That the desperation that reeks, unfortunately, leaves an incredible path of tears. Okay. It may be that you are able to turn this into something that gives you an incredible financial future. But more often than not, when that happens, it leaves you in financial ruin. Okay. If you are going to put a significant investment towards it, that is equal to or less than what you can afford to lose. If for some reason it went to zero, think about that. Okay. And the other thing is that as you look at that, just remember that we're still in a weird Wild West with all of this, because as I've said before, if this is truly going to be a currency of the future and replace currencies, it cannot be a sustainable currency at the level of speculative investment it currently is right now. That has to temper down before it's going to be a useful tool from a currency and transaction. You can't have something that is changing by double and triple digit values and use that as something that's going to be able to be used for transaction. You can't say, hey, my currency's worth 50% more today than it was yesterday, but tomorrow it's worth 100% less than that. Just be mindful. We are still working, we, not us, but this world, this global economy that we're in is still working through how this can be utilized and the impact of it. And as of right now, this is purely a speculative investment with all of the potential rewards, but all of the extreme risks that comes with that. Don't be foolish and understand this is going to continue to have significant spikes and declines, and you don't want to be on the wrong side of it. So that's the thought I have there. So
Okay. All right. So we're going to touch on a few charts here, and then we can kind of wrap it up. So I wanted to start with I think it's chart crime time, Doug, isn't it? Isn't it chart crime time?
I love chart crimes, Kirk.
Let's dive in. So I'm going to thank Doug for this one. Doug gets all the credit for not only sending this in, but also for responding to this post. So Steve Harvey is a permeable when it comes to homes and home ownership. Here's a chart that Steve Harvey published on X, which said, "Wow, the gap in net worth is widening," and he picked 2010 to 2020. Now, what do you notice about this chart besides the fact it just goes up the whole time? Well, it kind of omits the big financial crisis where real estate went into the toilet, right? It took the bottom of the real estate market, which is right around 2010, and it went to like 2022, not 2023, 2022. Okay, great. It just says like homeownership builds wealth, period. And here we go for Doughboy, which is Doug. He calls him out on the chart crime. I love this. And the chart only goes back 2010. So I was questioning why cut it off? And he responds with a chart that goes all the way back to I think in 1900. And it's like, oh wow, look at that! Magically. Maybe it's the 90s. I can't see.
I believe it's the 60s. It might be the 60s. It still
might
goes
be the
back
60s.
a little bit further than that, but I might be wrong. I got to go back and look at it again.
Yeah, 60. Sorry, it looks like 69. I can't read it. But yeah, no. Anyway, it doesn't matter. The point is here's one that goes back to like the 70s, let's say, right? And of course, the part he picked, if you look at it, it's like, oh, he literally picked the very bottom of net worth and real estate to a sharp degree. So really, what it comes back to is actually it hasn't changed all that much. I love this. This is chart crime at its best. Permeable cherry picking dates at the best possible date. It's like picking like the war in the Great Depression back in the 30s, picking the very lowest point and saying, "Oh look, the stock market always goes up." It's like, yeah, okay, good luck with that one. I guess there's a lot of people around who don't know history, so maybe they wouldn't notice. But yes, Doug, thank you for calling him out on this. Lovely job at pointing out people who are just basically not making the world a better place, making it a cheerier place, but not a better place in terms of facts. So thank you for that.
Well, and the only other thing I'll add to that is, again, it's this immediate assumption that he has that it's clearly a correlation that people, the point he's making is that people that own homes will now naturally have a greater net worth than people that rent. Okay. As we always say, correlation is not causation. Maybe the people that already had a greater net worth are the ones that were able to take and diversify and be able to purchase homes in the first place, that they had better economic means. There could be other variables as well. The other thing is, as you're trying to look at the bottom, which is the renters and how that net worth hasn't necessarily grown, like you just said, Kirk, interesting. When you go back to 1969 until that massive spike at the end, the first couple of years, actually, the homeowner net worth was declining. The renters weren't. And if you take and stretch it out the line, it ends up being that until the last major spike of the last couple of years, sounds like the net worth was holding pretty steady between both of them.
I think if so, and I want to bring this out not only because Doug kind of called this out, and I think Doug was quite frankly too nice for X. I think you need to unmute yourself when you're on X because you could have been much harsher on this.
Well, that allows me not to get blocked so that I can come back and call him out on more chart crimes.
That's true.
I'm playing a balance there because because there's just so much entertaining chart crime crap that gets posted on X that I don't want to be prohibited from being able to make fun of it next time.
Yeah, playing the long game, Doug. Playing the long game.
The long game. That's what I'm playing. The long game. Like his second chart, the long game. I'm not playing the short chart crime game.
So here's one thing I want to point out because I think this is a good example. So obviously Doug did a great job calling this out on the dates. Here's another one. Okay, so if you're looking at this bottom chart, right, the top one is obviously trying to tell a story. Like we talk about a lot in the show. It's really clearly trying to tell a story that that basically homeownership builds wealth, pro ownership. Everybody needs to own a home. Like, yeah, why do you think he's saying that? Because people aren't buying, right? But here's a way. If you were to do the chart from in my opinion, the top chart was intellectually dishonest. The bottom chart was a little bit better, but it could be even better. Now, if you're trying to do a chart that actually shows data that's maybe more revealing, and what I would have done if I was Doug, and Doug and I are not sitting around, we're not chartists, we're not sitting around creating charts. So we don't, as you can tell, we don't do that in the show because it takes a ton of time, and frankly, it's almost not worth the effort to do. But if you were to create one, here's how I'd create it. And actually, I'll point this out. You can go on Fred, the Federal Reserve of, I think, St. Louis is Fred. They have great charts and data. So you can go on their site and you actually create your own charts. But they don't pull in all data, but they pull in a lot of economic data. So if you want to create stuff, I love that place to do it because they allow you to do almost anything. It's great. So what I would do actually on this to make it more realistic, because you're looking at home ownership at the top is based on numbers. It's like, oh, here's the net worth. And the bottom is like renters. Well, let's be honest. People who are renting probably can't afford to buy a home, right? That's mostly, not always, but mostly the case. People who can buy a home, even some who can afford to buy a home, are still buying a home. And naturally, most people in this country's net worth is tied up in real estate. So obviously, this is going to show a higher number for people who own a home, just naturally, right? But if you wanted to show whether net worth is increasing, decreasing, or sideways, what you should do is percentage return. So starting in this date, percentage return, how has it grown or shrank? So if you took the left numbers, instead of putting these numbers as, whatever they were, like 100,000 up to 450,000, instead of that, you just did percentage return. You could say, okay, great. This is more accurate. This is what a home is doing for your net worth growth, right? That I would look at and be like, all right, that's an honest chart, right? But if you're doing it based on numbers, it's like, what are you actually telling me? Who doesn't know that homeowners are naturally going to be more wealthy than people who aren't homeowners in large part? Everyone. So the chart's meaningless. It's just like, oh, look what I did. I put these charts together and it said with the story I wanted to tell. But we all get influenced by charts because they're visual. And sometimes they're even visceral, right? Like you're just
we love charts. And we love charts.
Yeah, they're great. It's the visual nature. Mm-hmm. Yep, the visual nature of it. Like here's a chart. Like I love this one, and I don't even do this. Here's the global trade flow of coffee beans. What a cool chart. I don't even look at coffee on a daily basis. I don't even drink coffee. But I'm looking at this, I'm like, oh, this is pretty cool. Like I didn't know Ethiopia did beans, and Guatemala, yes, Honduras, India, Indonesia. Like, oh, this is pretty cool. Brazil's the number one, Vietnam's number two. I knew that about Vietnam, but although I thought they were number one. But anyway, point being is it's like, oh, that's really cool. And here are the people who consume it: U.S., Germany, Italy. So it's very.
I'll drink to that.
Yeah. Anyway, so the point is charts are visual. They are persuasive because of the visual nature. Something to keep in mind. Doug, take us home. It's at the hour. We're going to wrap it up here, so take us home.
Well, listen, you saw my personal Twitter out there. I guess if you want to follow me on it, I don't know. It's pretty useless. It's mostly sports, but it's Doug_H_boy. So there you go. So you can come harass me there, I guess. But really, if you want to get some information, there's going to be more stuff I'm going to be putting out on social media through some other channels on my main thing, Pro College Planners. It is for many people. If you have a high school senior, you already know this. FAFSA got delayed this year, just got released in January. People are going through this, so it's a very late scramble to get college selections taken care of. And college creates a lot of anxiety, and it creates a lot of confusion for families. And at the end of the day, if you don't know what you're doing, it can create a lot of financial stress. And you don't need that. I guarantee you don't want that. At the end of the day, you want an extraordinary outcome from your child. You want them to be happy, and you want to be relieved. And unfortunately, too many times, one of those things doesn't come true. So get the information. Go out to our website, procollegeplanners.com, procollegeplanners.com, or email us at info@procollegeplanners. We have a free report. It'll take you 5 minutes. Find out how much colleges think you can afford to pay, where you can get financial aid. You can also find out some other schools that might be more affordable based on your situation. And again, it's 5 minutes and it's absolutely free. If you have any questions, we'd be happy to talk to you, but go out there, download it. It's an incredibly important place to start as you get into this journey, because not having the information can create a very disappointing outcome.
Yeah, thanks, Doug. Thanks for joining us this week, and thanks for your input, and especially your policing of chart crimes. Really appreciate that. We're gonna have to build out that segment of this show.
More to come.
Much more to come. We see these all the time, and I just like cringe when I see some charts. So I think that's gonna be a segment we're gonna build into the show this year, is more chart crimes, and teach you how to look at the world. I mean, that's really what we're here to do for everyone. Is we're trying to teach people how to think about investing. Not what to think. That's what every other show does, what to think. We're not teaching you what to think. We're teaching you how to think about investing.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.